All right, folks, today we're going to be looking at what I call an emerger. What is an emerger? An emerger is a company that has recently emerged into profitability. Um, these are newer companies. They operate at a loss for X amount of time, and if they do well and succeed or whatever, then the expectation is that they have a point where they emerge into profitability. So I try to catch them at their first ever reported quarterly profit or annual profit or etc etc etc. So who are we talking about today? We're talking about Fluence Energy. But before we continue,
The facts in this communication are not facts and are for entertainment purposes only. All facts communicated are unreliable and may be invented.
who is Fluence Energy? Fluence Energy is a Siemens and AES joint venture right here. They operate in the energy sector, doing stuff like developing software and I guess kind of like management solutions and stuff for like these energy farms. So I think that's an interesting sector because there's definitely demand and like there's gonna be activity there. Like just from the data center and AI demands alone, this sector is expected to grow. Like it just is. And Fluence has it's not a startup. It's a planned enterprise by major players, major established players in the industry, for the purpose of a specialized delivery. And so I'm seeing that as like infrastructure management products. So that's cool. But they also provide engineering and delivery deployment. Okay, so whatever, operational and maintenance. So it's effectively, this sounds to me like a very much a utilities type company. But we will be looking at some of their competition from a different perspective. So where did I find them? I found them on earnings.cc. If you are familiar with this website, you'll know that when a company reports anything earnings related to the SEC, it ends up on here just minutes after. So who else is on here recently? We've got Abercrombie, Snowflake, Lowe's, Target, Dick's, Starwood, BJ's, CrowdStrike. I did a video on them, check it out. As you may remember, in the summertime there was a bit of a scandal, a global shutdown caused by CrowdStrike. Anyways, you get the idea. I'm sure you guys noticed the dates here and the timestamps. So Fluence, they reported on Monday. So let's look at their kind of like their activity a little bit for that period on day. So you can see on the Monday they kind of tanked. They really sort of tanked. Maybe let's use these candles so you guys can see easier. So you can see on the Monday they just crashed. They opened real high, but as you see here, their report was after hours, right? So after hours they crashed. I don't know why, because I mean, obviously they're still in a phase where they're valued a little richly because of the growth in early stage, but I don't know. Headlines, 10K report. Okay. Yeah, so anyways, let's look a little bit more at some of their fundamentals. Revenue versus net income. This is a wrong title. This is gross profit, not net income. So you can see the green here. It was like negative, but there's a clear upward trajectory here. Same chart. Again, upward trajectory, growing split between operating expenses and, cost of revenue and revenue. So it's your gross margin right there. Your gross profit, acceleration, upward trajectory. This is your net income, your zero lines right here. Again, we busted right through that, right? What do we have here? Cash flows, annual. So you can see right here, really bad operating losses in 2020, 2021. However, you can see that they raised a lot of money and they had high investment, right? So they would have been paying for operations, but also investments, which resulted in, operating losses and capex, but that positioned them starting in 2021 here to springboard into growth and profitability, right? This is a profitable free cash flow year, right? 71.5 million in free cash flow for fiscal year 2024 ending September 30th. So you can see how these early financing and investments paid off 2 years later. Again, planning by experienced operators, AES, Siemens. What do we have here? Revenue, cost of revenue, gross profit. Again, you can see the upward trajectory. You can see the breaking into profitability, right? Operating net income and net income. So you can see a steady trajectory plus a springboard, right? Once they can jump into profitability, things tend to snowball for good companies, right? And like I said, these guys are managed, they're backed. Again, you can see their EPS broke into profitability. It wasn't their first ever profitable quarters. For some reason I didn't catch these before, or maybe I didn't overlook them, but this stands out, folks. It stands out. Assets and liabilities, you can see the investments that they made. They did them in a way that brought them from net equity in 2020 and 2021 immediately into positive equity, right? Which has continued, and we've now busted into both free cash flow and net income profitability. Gross profit and operating cash flow, see? Now, an interesting thing to note is that their free cash flow, see, it follows the same trajectory as their gross profit, right? So what that tells me is that their free cash flow is tied to their operations, which is good. Sometimes free cash flow is not tied to operations. It might be from other sources of incoming cash. So it's good to observe that their operations follow the same pattern as their free cash flow. Let's look at a little bit of their valuation real quick here, folks. And by the way, if you guys are finding this interesting or useful, please hit that subscribe and like, because I'm trying to have a channel here. And the purpose of my channel is to try to show and tell how I go about finding really high growth companies. Now, I've used this exact method to catch some really, really good breaks. I used this method of catching an emerger to get into Tesla very early. I mean, not hyper early, but I've got hundreds of percents in profit in Tesla. The same method got me into Palantir before their 2 bursts of explosion. So I got into Palantir when they first reported their profit, right away. They're also hundreds of percent profitable for me now. I got into several other companies. I'm not going to go through them right now. Those are 2 notable high-profile companies that this method has got me into. Again, searching for mergers is a high probability payout strategy, and that's what I'm trying to teach you guys. And this site, earnings.cc, is intended to facilitate that process, okay? It's a tool that I built for myself, but I'm sharing it. So again, I'm asking for those likes and I'm asking for those subscribes. Feel free to check out the website. Feel free to use Contact Us. feel free to leave comments in the video. Anyways, so this is their fiscal year ended. So they've reported, and again, it's important to note that myself and Yahoo both report on the attributable to Fluence, not the total corporate, right? Because they have a non-controlling interest. My guess is that that's Siemens and AES. But we're focused on these numbers, right? This is what I report on. This is what Yahoo also reports on. So that's what you can look up. And we're also focusing on the diluted, by the way. So for the fiscal year ended, we've got 13 cents with 22 million. But if we drop down to the 3 months ended, we see a different value, right? So you have to take into account that this still is including some unprofitable quarters, but they've crossed into that threshold of profitability. We know that they have 4.5 billion in backlog because they reported that up here. See, quarterly backlog of 4.5 billion, 1.2 for the quarter. So that's a lot, folks. Where are we here? So out of 1.25 billion that they made in revenue, attributable 47, 48. Okay, so let's just see what that math is like. 47 divided by 112.1230. Ah, come on. 230. That gives us about 4% margin. Okay, so that's not great. It's not great. If we look at their free cash flow at the bottom for the year, 71.5 out of revenues for the year. Revenues for the year of 2.7. So that's 71.5 divided by 26.99, 2.5%. Okay. So let's say they make 3 billion next year in revenues times 0.04, so that's 120 million in net income. $80 in free cash flow, 85. Now let's use their current diluted share count. Let's call it a 185. So we've got, oh man, what did we get? We got 120. 120 million divided by 185. So it's about 65 cents per share at $19. That gives us about a 30 PE ratio. Let's try it a different way. Let's take that 4.5 billion. Let's say they're going to process 2 billion of it. Let's just give them a 5%. 100 million divided by 185 million. C54. 35 PE. Let's take a look at their quarterly. Oh wait, this is their quarterly. So let's just extrapolate off this number. 34. So let's go 0.34 times 4, 136. 19 divided by 1.36. Let's just leave it at 1.3. So that's a 14. So we've got potential PEs ranging between, let's call it 15 and 30. Totally reasonable for a solid company. And this one appears to be in a growth stage. So I don't know, that's fairly attractive to me. Let's look at their revenue growth. So their total revenue, like it's doubled. 50% growth, 100% growth. Let's look at the annual. It's 20% growth. It's 100% growth. I'd say this is a growth company. Let's look at their free cash flow. Like, they're doing good. We saw the charts. They have nearly 5 billion locked up. This is a high potential company, folks. This is a high potential company. Let's just take a look at Siemens real quick here. Actually, Siemens doesn't really have a whole lot to show. You can look that up on your own. Oh, man. Okay, so you can see Siemens is one of those companies that just kind of plays steady as she goes. Their dividend's at 5 1/3 right now, so they're just one of those companies that operates and pays out their dividend, right? They go up and down, but you don't see any real major growth. So you can expect dividend type behavior out of this and utilities type behavior, but now is an interesting time for them. They're relatively cheap relative to their range. Their PE ratios are decent. We've seen that their free cash flow loosely mimics their operations. Man, just crossing into that profitability. They have planners and backers that are experienced operators. They're in a sector that's expected to grow. We know they will. Like companies like Microsoft, AWS, Tesla, Google, they're all Meta, they're all laying down massive server farms, massive electrical infrastructure, massive data centers, massive solar farms, massive wind farms. They're doing it, folks. So this is a high growth, high potential find. It's an emerger. Like I said, I'm doing this to show and tell, to try to teach other people my method. It's worked pretty well. I'll be doing more videos. Hit that like and subscribe. Thanks a lot for tuning in, folks.